Good morning, ladies and gentlemen. Well, another week, another record close. Risk is on fire. We're going higher. That's all there is to it. The scores in the high 80s, 80 and above, or 75 and above, is very, very strong. But don't expect this indicator to tell you very much in the next few days and weeks. The one which could tell us something very interesting is on the counter trend page, and you have to go scroll down to the bottom and have a look at break. It's only activated twice, but every time that it's activated, and the description is in the box below, the market basically retraces down to the 25 period moving average on the weeklies. And I'm highly hopeful that very soon, in the next couple of weeks, it will actually activate. I will naturally go through in detail what my expectations are for the next couple of weeks, but please do keep an eye out on this one, because we're getting to a ridiculous position of hugely overbought markets like we had in 2013 and in the early part of 2018. What is going on in the US yield curve? Well, it's actually very stable. The 2s 10s are doing some kind of a bull flag, but I still think the odds are that the market has entered a period of stability in which we could retrace some of this very steep move and probably go down towards this 126, 127 area. I don't think that is going to be done by 10 years coming off very much. It's more likely to be done by 2s and 5s going slightly higher. The Fed has not changed its mind, but I think the economy is going to be very much on fire, and that is going to shift market expectations for when the end of stimulus stroke beginning of tightening might be. They're going to bring it forward by a few months, and that should put some pressure on the 2s 10s. But I must say the bonds are very stable at the moment, and we'll look at the individuals next. But it's very stable, and that is what it's actually feeding the frenzy in risk. The rest of the yield curve is just as quiet as the 2s 10s. If we look on the weeklies, 5s 30s, we can see that basically I was right, and this 139 basis points level was very important. We went through it last Friday, and when it was really thin, and we came back. So getting out there was a good idea. I still think this 154 area is going to be very good support for quite some time. And if we look at it on the dailies, I think it's quite clear that we still want to buy below 154 and really trade it towards 144. I think at some stage you will find that the curve pivots around the 5s, around the belly. They sell the hell out of the belly, and we break the 140 level, and we go towards this, I would say around here, around 122 would be my target. Yes, that's 122. That would be my target eventually. That is the sort of thing that I'm looking for. And basically this is what tells me that the curve is more likely to flatten longer term than steepen. And this is the 10s 30s. It's really now entered a period of stability. That tells me that 200 to 220 basis points is going to be where the longer end goes towards, i.e. the 10s. And that is where the 5s slowly will push up towards and make the curve flatter and flatter and flatter. So that is what I think is going to happen over the very long term, i.e. that short-term rates are going to start catching up with long-term rates. Does that mean that it's going to happen next week? No, it just means that I think the path of least resistance slowly is going to be for a flatter yield curve from here. What does that mean in terms of yields for each individual tenure? This is now the 5-year note. You can see how last week has really been stability itself. We just gave back what we took on Friday, but I think that this level, 78, 79 basis points, is going to be as low as we go, and we will push over the course of the next few weeks up towards this 117 level. I think that is definitely the path of least resistance. If we look at the tens, stability with a little bit of, I would have thought that the tens are going to top out between 185 and 203. I think over the course of the next few weeks we do touch 2%. I think we still have one more leg in it, and that is why I'm particularly bearish of Europe, because I think the spread between the US and Europe can start coming in as people realize that the situation is actually better in all these countries than the market is anticipating, and the mad dash towards risk on continues for another week or two. What I think is notable is that last week, while US rates were slightly lower, and we're talking about a couple of basis points, German rates and European rates in general were slightly higher. Okay, we're only talking a couple of basis points, but I think that is, we are getting definition, and at some stage, this is the bubble, we are going to break this level, this minus 61 level. Minus 59, a break of minus 59 definitely confirms that we're going to minus 52. I think the European markets are very vulnerable. I think the likelihood that we will break in both the fives, and now this one is the bubble, and the level there is 22 and 17. I think the likelihood becomes greater and greater. Is there a chance that we see our level here at minus 38, minus 39? For sure. You know, we will have some days of risk off. The stock market could come off a few basis points and people panic back into bonds, but I think that's going to be a wonderful opportunity. I think the bond market, the macro picture in Europe is looking so much better. The economic surprises are going so much better. And as Christine Lagarde herself said, the first thing that will go is this emergency program. You can just imagine what bonds are going to do the day they come out and they say, we're abandoning the emergency pet program. They're going to go up 10, 15 basis points that day. There is no reason that I can see for negative rates at the moment in Europe. Inflation is going to be 1.5% very soon in Europe. Okay, we certainly lag behind the States in terms of inflation, but it's just too much. There's no reason to be this negative this far into the rally in risk and into the economic expansion. I think it's just too much, and I really would not be surprised if in a year's time we were trading positive in every single segment of the curve in Germany. What we have to ask ourselves is, how can we marry my view in the bonds in the 10 years that they go up towards one between 185 and 203, like I just showed you, and my view that Bund rates are going to be positive in a few months. Well, this is now a monthly chart of the differential between the 10-year note and the Bund, and we can see that around 170 basis points, it's actually where the average has been for the past several years. If we return towards 175 basis points, and I'm right, and 2-year notes are at 2, that gives us a Bund of around 25 basis points. Now, this is not going to be a 25 basis points positive. Now, that is not a prediction for the next week or for the next month, but over the course of the next 4, 5, 6 months, that is the kind of move we could see. Because let's face it, if the Europeans get their act together on the immunization program, the vaccination, I really don't see why they wouldn't. If they meet their targets to have the population vaccinated by the end of the summer, you will have thought that the rotation out of negative yielding bonds would be one which would make a lot of sense. It naturally follows that if I think that German and European yields in general are going to be higher, go higher eventually and outperform even US yields, I cannot be positive for the US dollar. It's just a tautology. What have we done last week? Well, we came right off. We could not close above 93.14, and that was just enough. And as soon as yields moved even a basis point or two in favor of Europe, smack back down we came to 92.16. And I now see no reason why we should not trade sideways down to 91.01. And this trend line has been absolutely to the tick. And now we will slowly, I think, produce some kind of a puke out in the dollar. On a macro basis, I just cannot get bullish of it. To me, I don't see what there is to get very excited about in the US in terms of, because of all the leading indicators are actually more positive in Europe than they are in the bigger surprises, the bigger misses to the upside are in the data are actually in Europe rather than the States. So while the States is doing well, Europe is doing better than expected. And I think that kind of differential should weigh on the States in terms of both yield differential and also the need the US has to keep the US dollar cheaper because of the enormous funding pressure that is coming in the next months. I just cannot see any reason to start being positive on the dollar. When can we start getting really negative on the dollar and positive on the euro? Well, I think when we start trading above this 119.86 level. It's going to take several days to do that. I don't expect it in the early part of next week or even next week necessarily. But you can see that if we start trading above that level, we are likely to break this level, and then we are likely to go up towards making new highs. Technically speaking, all that's happened here is that we had an ABC down. It touched exactly the 138 times extension, exactly the 38.2% retracement, nearly to the tick, and now over the course of the next several months I expect this to break higher, and the signal is going to be a break of this 119.86 level, taking it to 120.12, and then eventually to new highs. And I would have thought 125, 126 is quite a reasonable level to look at over the course of the rest of the year. My old friend gold, I'm sorry, but I just can't buy you. If I'm still relatively bearish for rates, and if I'm relatively bearish for the dollar, I just cannot touch gold. As I said last week, I would be impressed by a daily close over 1,764. More or less, that's exactly where we topped out last week. I just really cannot see what there is going for gold. Some kind of a risk-off move would possibly get gold going on the upside as some sort of a refuge in inverted commas, but I just don't see it. I really don't see it, and I think it's more likely that it comes down and retests the 1650 level and eventually breaks into the sort of around this 1592 level, that kind of thing, where the 200 week moving average is. I really don't see why you would even want to trade it apart from to short it at very significant levels like 1764 or buy some put spreads or something. Unless I'm very wrong in my macro view about bonds and about the dollar, I really cannot see even the worth of thinking about gold over the next 4 to 6 months. I want to start this week's review of risk by looking at a weekly chart of volatility, because I think volatility is going to offer us a very good opportunity at some nearby stage. If you remember that break chart I showed you, break activated only twice, and that was in 2013 here, and then in the early part of 2018 here. You can see how much higher volatility went in 2018, although we had in percentage points much the same kind of move. It went from, the ridiculously single figures all the way up into the 40s, but very, very quickly came back towards 2251. And in 2013, it never broke 2251, but got to it. So 2251 to me in volatility is a very, very important level. And when we oscillate around it and decisively break down, as we have in the past 4 or 5 weeks in volatility, that is to me significant, because that means that we go to the next support. And here we have the next support. It's between 1608 and 1540, the 1540s. You can't be that precise in volatility, but basically anything below 16% and north of 15.5% is to me an area where we can start accumulating call spreads, because let's face it, volatility could easily go down to 1228 over the course of the next 2 or 3 weeks. That's a move that if you're in futures you just cannot sustain, but if you are in call spreads you really don't mind, especially if they're 2-3 month call spreads. And I think volatility is going to give us that opportunity, because I think that however low it goes over the course of the next 2 or 3 weeks, it will trade 2250 again. So I really want to buy 2-3 month call spreads, anything that in this area, and that gives us the potential to resell it at a huge profit at 2250. And yes, I know we are in the red. We've been in the red all week in deviations, and yet I cannot sell it. I cannot sell it because I recognize that the timing is all wrong, and I recognize that the market needs the risk. The bonds have stabilized, as we've seen. They might drift higher, but we are within 20, 30 basis points of where they're ultimately going to settle and then start turning. And the market just needs risk. It's discounted all the 90% of what there is to discount in bonds, and therefore it just, there is no reason not to have to be risk on at the moment. Um, We are coming into earnings, the beginning of financial earnings next week. We have JPM reporting, we have all the other big banks. I think their numbers are going to be stellar. I think they're going to be ridiculously good, simply because so much of the stuff they had in the non-performing side of the balance sheet, they have to transfer back to the performing side of the balance sheet. And that goes straight to the bottom line. Um, we've seen how the leading sector has been financials and industrials in the past few weeks. We have XLK also into the red now, but you look, XLF is not in the red. I think over the course of the next week, XLF will get into the red. And that could be our signal that we are somewhere close to exhaustion. XLV still going, XLP, and here's XLY, which is the big one. It's made the new all-time highs. I think Amazon is going to drag it into to the top of the red, and I would not be surprised. And going back to the S&Ps, if we came out of the ×3, simply because there is nothing to sell. No sector is getting sold. No money is leaving the market. It's just rotation from large caps to small caps, from one sector to the next. Net money is coming into the market, and this is one time I'm not going to fight it. I'm going to let it get really, really ridiculous. And now let's examine what really, really ridiculous could mean. But I think it's probably more ridiculous than even the biggest bull in the world can assume. Let's start by looking at a weekly chart of the S&Ps, and you will notice that we're through the Bollinger Bands. I think we're going for a repeat of this period here in early 2018. Probably another couple of weeks. I don't think next week is going to be the end of it because of the earnings, and I think they're going to be stellar. Now, could be wrong, but I think that is going to be something which propels us even higher and gets people even more bullish, and then finally we can get the exhaustion. We're not going to get the exhaustion while it goes up 0.5% a day. We're going to get the exhaustion when it goes up 1.5% to 2% in a day. And that is still, a long way away. I think we could easily get into the 4200s or even the 4300s before that gets so ridiculous. But what I want you to see is the lack of structure now. Basically, we have nothing on a weekly chart until 39.39 on the downside. If we look at the other charts, if we look, for example, at a daily chart, we really have no structure, nothing, until 39.83 on the downside. What I'm trying to say is that, yes, we're getting slingshots higher, and we will continue to get slingshots higher, and do not try to pick a top, because the top is going to be even higher than you can possibly imagine. But when we do turn, the turn is going to be down towards 39.83. Going back to the weekly chart, you'll be interested to know that this red line is the 25-period EMA, and that is where the market tends to come back to. This is the early part of 2018 that you can see down here, and that becomes the new equilibrium point for the market reset, in my experience. Now, in 2 or 3 weeks' time, that line is going to be around 38.70 or so. So that is where I think the market will come back to. I'm just trying to give you an idea of the volatility that we're going to see. So if I'm looking for 4,200 plus on the upside, and then a move down to 3,800, I'm looking for 400 points, which is, not a huge amount in percentage terms anymore. It's like 10%, right? So, so if I'm looking for a 10%er over the course of the next 3 months, that makes volatility, if you do the maths, that makes volatility down at 16 to 15% ridiculously cheap. Both on the upside for the move that you're going to get, and for the downside correction you're going to get back down towards the 25 period moving average. So whichever way you cut it, this is going to be extremely cheap. Back to the daily chart, just no definition, but the Bollinger Bands, I think in 3, 4, 5 days time, when we finally get the because the JPM earnings aren't until Wednesday, in 3 days time, well, we could easily spike 4,200. I mean, easily spike 4,200. And if we have a look at a 195 minute, I just want you to see how there is no definition whatsoever between, until 40.68 on the downside, and then nothing till 39.74 in terms of definition. So that tells me that when things turn, the volatility is going to go into the 20s without any problem. I showed you the level that I think it will touch. Whether that is going to be the peak or not is neither here nor there. I think we definitely touch it. So we will have some fantastic opportunities over the next couple of weeks. So don't be worried. Don't think that you don't need to chase it. We will have some fantastic trading opportunities in the next couple of weeks. Before I cover NQ, I want you to have a look at the technology spreads against all the other sectors. This is XLF, this is XLV, this is XLI, this is the Qs against SPY, and this is the Qs against IWM, against the Russell. It's much of a muchness. It's just meandering in all of them, which tells me that technology, while the moving averages are also pointed downwards, it is unlikely that technology becomes a leader quickly. So what I'm saying is that technology one day is going to outperform, the next is going to underperform. So it's really, we cannot rely on NQ to be a positive indicator at the moment. Having said that, weekly chart of NQ, difficult to say it's bearish, but I also want you to see the lack of definition there is in this chart too. Unless we now start breaking the highs, which I think odds are that we do next week, and also the other reason why I think that it's unlikely that we start a correction in the next week or so is because I still think that we're going to get very good earnings from the tech companies. So that is going to hold us in for another couple of weeks. So I really think that it's going to take a good while for all these things to change. Here we are on a daily basis and on a 195-minute basis. To me, we're so close to the all-time highs that we're definitely going to stop people out above the 13,879 and then the 14,000s. What is important to note is that all the charts are now lacking definition, which leads me to the conclusion that whenever we get the correction, it's going to be very fast and furious. Whichever chart of risk I look at, nothing is really screaming that it's ridiculously priced, although we are very close to or above the Bollinger Bands in just about everything. It just tells me that it's just going to crawl and suck more people in. The DAX is really the one that I am least bearish on, because I think the big macro rotation is going to happen to it. It's just that it's going to get whacked just as much as the S&Ps when finally the correction happens and we get that move in volatility to the towards the 25 area. You can see the lack of definition here. It is going to come back to 14,100, 14,200 when that finally happens. In the meantime, I still think it goes very close to 16,000. The stock futures, I think, on a monthly basis, I think they will go up and then they will come down and probably retest the 3,770 level and then go back up. I don't think that the correction that we will see, I don't think it'll mark a long-term top. I think it'll just mark an exhaustion top that it's going to take us probably most of the year to get out of. And as you can see, Nikkei is also tired. What used to lead is now no longer leading. It has no impulsion, but it's creating definition. That's the Nikkei I'm probably the least bearish on. If we look at EEM, let's have a look at EEM spreads first. We can see that EEM against Japan is actually doing very, very little. EEM and Japan basically are flat, and they are basically saying that they are going to follow each other. It's come a long way back against Germany, but it's coming to very good support with this moving averages. So basically what it's saying is that very soon EEM is going to start trading in parallel with Germany. Same story for EEM against FEZ, which is the stock 600 in Europe. But the picture is completely different against SPY. It could easily go and try and make new lows, but I think it'll bounce like a bull when it does. But this is the as I keep on saying, it's doing nothing wrong and it's doing nothing right. I can't be long of it. I can only be short of puts. And this is my actually longer term theory of what it can do. It can be dragged up towards 55.83 with everything else, with the ridiculous, move in S&Ps that we could see and in NQ in the next couple of weeks. And then it's going to do an A, B, C, and probably come down towards 50.23 or even 48. This kind of level does an A, B, C, whatever that happens to be, and then the big move happens. I am bullish long term, and I will not change my mind that I'm bullish long term. I just think an exhaustion is coming in the S&Ps. I think an exhaustion is coming to all the rest of all these markets, and I think volatility is going to be the safest way to play it, because we know that it's going to go from whatever the bottom is, it's going to go back up into the mid-20s without any kind of a problem. Thank you very much indeed, and tweet you on Monday with everything that we're going to do in volatility, and I'll just post the summary sheet without going through it, because not a lot has changed and I don't want to tire you out.